Hi everyone, Happy New Year. Thanks for joining us. We've had a bit of a break in our series of 10 webinars. We're now up to number 8 and we're looking at Ichimoku charts. Clive, have I said that right?
Yeah, pretty much so, Chris. Yeah, you're there, mate.
Good,
You're
good, good.
there.
Happy New Year, Clive, and
Thank you
over
very
to you.
much. Okay, so on the screen there, just to start you off, is an Ichimoku chart, which might look a little bit confusing. It's a candlestick chart, basically, with a whole number of lines on it and shadings and stuff. Hopefully, by the end of this 45 minutes or an hour, however long we take to do this, we should be a lot clearer on what that's all about, and you may decide that this is something that you think you can use in your trading and your charting. It is Ichimoku is the name of this charting methodology, although that's a shortening of there's a short version and a long version, really. There's the cloud charts is what a lot of people in the Western world just call these, which makes life a lot easier. The long version is the Ichimoku Hyo charts, which is obviously you can see why there's shortenings used. They're Japanese. They were first developed in the 30s, first published in the 60s, and came into prominence and use in Japan in about the 80s and 90s, and in the Western world really after candles came to prominence in the Western world. And so it's only really been in the last 15 or so years that a number of leading technical analysts in the Western world have started using the technique. Some of you may be familiar with Nicole Elliott, who used to be at Mizuho, who's a good friend of mine, and she's now at the Financial Times and Investors Chronicle. She is a bit of an expert on the cloud charts, as is a chap called David Linton, who runs a thing called Updata, and he's written a book which is the definitive guide to Ichimoku cloud charts, and is an excellent read if anything you see today piques your interest and encourages you to read up further. So without further ado, let's have a look at this methodology, and it's a little bit there's a bit to this, but we'll be absolutely fine, don't you worry. Right, there are 1, 2, 3, 4, 5 lines on an Ichimoku chart, and two of those lines have the shading in between. Let's go through the 5 lines just to start with. The first line is called the turning line, in Japanese Tenkan Sen line, and that is the midpoint of the 9-day range, quite simply. So you just look at the last 9 days range and you find out where the middle of that is, and that gives you that purple line on our chart. Pretty simple stuff to start with. Then the green line on our chart is called the standard line, or in Japanese the Kijūsen, and that is the midpoint of the 26 days range. You might be familiar with these. 9 and 26 are sort of similar values that are used in the stochastic oscillator, so it's interesting how two completely different methodologies have kind of come up with the same with very similar values that they're using for these for its calculation. So that's our standard line. I've got to be honest with you, in my own personal analysis of Ichimoku, I've never really used either of those 2 lines. But that's what they are, that's where they are, and so and I think a very basic use of those lines is to say that the market is bearish if we're below those lines, and is looking bullish if it manages to get back above both of those lines and is rising. So that's our first look, if you like. A little bit, think moving averages, for the interpretation a little bit. Our third line is that red one there, and that's called the cloud span A, or the Senku span A. Now this is the midpoint of the standard line and the turning line, so we're using those first 2 lines. We're finding the middle point of both of those, but what we're doing actually here with this line is shoving it forwards by 26 periods. Okay. So actually what you can see is we have that's our last candlestick there, but we have lines that are continuing out past, into the future, if you like, a little bit. And it's one of the very few charting methodologies that has any kind of application, if you like, for looking forward. So that's the cloud span A. It's the middle of those two, the first two lines, and it's pushed forward 26 periods. Cloud span B is the Senku span B is the midpoint of the last 52 periods, and again is shifted forwards by 26 periods. So this is all a little bit complicated, but it's all there on the slides, and you can go back and have a look at this at a later date if it's something you are looking to really read up on, if you like. So yes, cloud span B is the midpoint of the last 52 periods, and again we've got that shifting forward of 26 periods. Actually, probably the nearest we've got to a Western equivalent is a 17-day moving average that's pushed forward by 26 days, and a 52-day moving average pushed forward by 26 days. And if I just toggle between the two, you can see how there are some similarities there between what the message that those things are giving us. And what those two lines that are pushed forward give us is the cloud. And that's what for me, it's at least the key visual element of this charting methodology. It's the thing that provides us with the real visuals, if you like, and can give you that kind of instant snapshot, if you like, of trend, and can just answer a question very quickly, straight away, without any messing around. Are we bullish or bearish? Okay, because if we are below the cloud, the market's bearish, and if you're above the cloud, the market's bullish. Quite simple. Okay, and so that's your key visual element, is the cloud. Okay, let's go. I think I'm going to get through these slides rather quickly. There is one more line that we look at on the Ichimoku charts, and it's the one that I particularly, it is one that I do use, and it is a line that adds one more layer of confirmation, if you like, and it's called the lagging line, or the Ichimoku span B, and that is the last close, but it's pushed back 26 periods. Okay, so whereas the cloud, the cloud. Oh, sorry, someone's saying they can't hear the sound. Chris, can you hear me okay?
Yeah, I can hear you, Clive, and we've got a test login here also, which can hear you fine. I'm just replying to Jackie.
Okay, sorry, Jackie, it must be a problem at your end. Okay. Right, so where were we? We've got the lagging line, which is the orange line on our chart, and that is the last close pushed back 26 periods. And now what the lagging line does for you is to provide, if you like, that very last bit of confirmation, if you like, of any trend that may be changing. Okay, because obviously it is 26 days behind, if you like, the price, and so once the lagging line moves through the cloud, at the moment on the chart we've got up there, it's below the cloud, and so it's a bearish market. The candlesticks would move up through the cloud to give a buy signal, and then once the lagging line also did the same thing, then you've got your definitive 100% ticking all the boxes buy signal, if you like, from the cloud chart. Okay, so that's all of the lines, and hopefully a little bit clearer as to what they're showing. And yes, it is a bit of a messy looking chart, which is, I think, one of the criticisms of Ichimoku charts that I've heard leveled at it, is that there's a lot on there. It makes for a very messy, noisy looking chart. And I think if for those of you who have been here who have been good enough to attend all of our webinars so far, I hope one of the sort of one of the overriding things that you would have got from it is that I personally am quite keen on the idea of keeping charts as simple and as uncluttered as possible, in order to make sure that they're actually doing the job that they're, the job we want, which is to help us to make trading decisions, as opposed to making life more difficult, or making making your decision-making process more complicated. I think it's a recurring theme of what I always try and get across to people when talking about technical analysis and charts. The charts should be there to make your life easier. So if you're looking at that chart right now, even having gone through the explanation of what all those various lines are, and you're thinking, look, that's just doing my head in, there's too much on there, then maybe this isn't for you. And I wouldn't blame you. It's each to their own, basically. You've got to find the things that work for you. And actually finding the things that work for you and combining different methods of analysis is very much going to be one of the things I want to spend some time on in our last webinar in 2 weeks' time, because actually at the moment, and this is something that I needed to flag to people anyway, so I might as well do it now while I'm talking about it. I have nothing on the agenda for 2 weeks' time. We're going to look at market profile and volume at price analysis next week for our 9th webinar. But for number 10, there's nothing on the agenda at the moment. It's very much a case of wanting to try and make it a little bit proactive. Lots of questions, lots of queries, lots of trying to look at different charts and different methodologies, trying to bring them together so that hopefully you can sort of say, you can ask me, well, how about this and this together, and how about that and that together, and that kind of thing. So yeah, that's just a bit of an advert for what we're doing in 2 weeks' time. Right, back to our cloud charts. The key elements that we look at FuturesTechs in relation to is the relationship of the candles to the cloud and the position of the lagging line compared to the cloud. And quite simply, candles are the price, the current price, and if they're below the cloud, then that is signaling a market that's in a downtrend. If price is above the cloud, then we are in an uptrend, and the lagging line adds that extra level of confirmation to the equation. So you are in a strong uptrend, if you like. If price is above the cloud and the lagging line's above the cloud, you're in a strong downtrend if price is below the cloud and the lagging line is below the cloud. So let's actually look at those kind of that idea on a chart. Okay, let's start right here on the top left hand side of this chart. At that time we have the cloud below us, and the lagging line is above the cloud and the price is above the cloud, and so you'd be long of the market at that point if we were to just use this on its own and we had a trading system that was entirely based on just this one methodology. And again, I'll say it until I'm blue in the face, it wouldn't be advisable to have a methodology, a trading system based on one methodology alone. This is very much a case of trying to find a number of different things that can go together to give you a robust trading strategy. Because one thing I can tell you for sure, these cloud charts are pretty ineffective in sideways markets. They can chop you around, you can get false signals. They are a trend following tool, if you like, and very much something that you would want to that's how you would employ them. Okay, so we'd be long here on this top left hand side of the chart when the candles drop through the through the top of the cloud. if you cover your longs and get onto the side and just stay on the sidelines until we get some resolution, then at this point here, when the price drops through the cloud, you get short. And why does this say confirmed short add question mark? It is because that candle there is where, if you look over here, the lagging line would have dropped through the cloud as well. So if you're short here and you want to add, then you could add when the lagging line also confirms by dropping through the line. And then you'd stay short. And you'd stay short all the time the market is below the cloud, which is until right over here. Okay, and when we close in the cloud on that day there, you would cover that short trade. Okay, I spent 3 days in the cloud and then fell back through. So you cover the short there. So you go short again there, and you would cover that short trade there when we go back into the cloud. Okay, and then you would short it again there because the same sort of thing happened. We just nudged into the cloud, but then fell over and fell back through the cloud. So yes, there are a few trades in and out there, but overall, I said, that would have given you a decent strategy because the market is in a solid downtrend and is moving lower. So that's how we're using the interaction of the candles and the cloud as for a trading strategy. Now the cloud looks forward, so actually what you can do is identify where and when you might get trade opportunity in the future, which is an interesting scenario and something, again, I think people sometimes say to me, oh, you're a technical analyst, right, so you can see into the future, can you? And I'm saying, no, of course I can't. And that's not my job. My job isn't to, I'm not sitting here at my desk every day with a crystal ball, stargazing or looking in, trying to be some sort of modern day mystic Meg. That's not what I'm doing at all. I'm identifying possibilities and probabilities and trying to construct trades around trying to pick market direction based on a bunch of, based on the tools at my availability. I can't see into the future. Who can? I don't know. There's probably got a few facetious answers to that knocking around, but there you go. Right. One thing we know about the cloud charts is that the thicker the cloud, the stronger the trend. Okay. But obviously, if we have a very thick cloud, then if you're saying that the cloud is above the market, we're in a falling market, and the cloud's above, and you're saying that the cloud is resistance, then the thicker the cloud, the bigger the zone of resistance. Okay, and it's very difficult to construct trades around the idea that maybe something is, if you used it actually textbook, then you might have some pretty ludicrous stops going on, which would be prohibitive with respect to risk reward on trades. So that can make life a bit difficult. Thin clouds, and we're going to look at this in a minute in the euro yen chart once I've gone through the slides, because I've actually I've fired up the charts for euro yen, and we can have a look at a few current Ichimoku charts for current markets. Where was I? Most analyst traders use this as a confirming tool, and as with any technical tool, it should not be used in isolation. I think I've said all of that already, but this idea of it being a confirming tool is really nice. I think if you've got a trading strategy in place already and you're looking for one more thing to say, should I pull the trigger on this trade or not, then the cloud chart could be that extra thing that says to you, okay, I've got a bullish trade, I want to buy the market, I want the Ichimoku charts, whatever the time frame you're looking at, I want the Ichimoku chart to say to me, yes, I agree, and you can buy. Okay. It can be particularly useful to combine with candlesticks, and that's exactly what it's designed for. That's what the Japanese, it's an overlay for the candlestick chart. What do I mean by that? Let's have a look at this particular. Let's have a look. I'm just going to skip forward. Okay, this instance here, we had a bearish engulfing pattern. It was only after a small pullback, so it's not an ideal one, but that the idea that we had a bearish engulfing pattern when we hit bottom of the cloud on that particular chart is kind of a big tick, if you like. It's like the candlesticks agree with the cloud chart that this, you know, we hit resistance, the cloud resistance, and we posted a bearish candlestick. You know, it wasn't so clean here, but I bet the cloud was very thin at that time. So let's just go back and see where I was going with this. Lots of analysts use 2 different time frame charts for Ichimoku, okay, and that depends on your time frame. As with anything, your time frame should be skewed to your trading style, okay? So, and listen, one thing I've noted with Ichimoku charts in my own personal experience, and you may find this different, you know, and I encourage you to go and have a look and use the methodology on your charts and see if it's something that resonates for you or works for you. But in my experience, they don't work so well on shorter term charts. If you're looking at 10 minutes, even 30-minute chart, you know, 10 minutes, 5 minutes, 30-minute charts, the volatilities and the noise is a bit much, and generally doesn't lend itself to this particular type of analysis. But once you get out to things like hourlies, 4 hourlies, dailies, weeklies, monthlies, then you know, they've got the innate noise reduction in those time frames anyway, and it tends to lend itself better to this form of analysis. So if you are a long only investor, if you like, then you could arguably say, well, I'm going to use the Ichimoku charts, I'm going to use the weekly chart, and I'm only going to look for long trades if price and the lagging line are above the cloud. And then you could move to the daily chart, and you could and look for the look where the cloud is on the daily for, this is where I'm going to try and get into this trade. Okay, so that's a sort of an insight into how you could use 2 different time frames of cloud charts to help you with your strategy. So yes, we got our sell signal from the cloud chart on this particular chart. This was one I just referred to when we dropped through the cloud here. But this gave us extra confirmation, as I've already shown you, with a bearish engulfing pattern being seen as we hit the top of the cloud on the retest. And it would be then a few weeks after that, is a weekly chart, it would be 1, 2, 3 weeks after that that we get the definitive tick, if you like, because that's when the lagging line, if you look back, you've got to look back and say, oh yeah, the lagging line's dropped through the cloud as well now. So we have had first sell signal, arguably a second sell signal, and there's the confirming third sell signal. You know, if you wanted to be really prudent and wait for the right opportunity, that's your third signal there. And this is the same chart but going to a daily time frame, and now the daily Ichimoku chart, as you can see, did a very nice job every time the market moved up to the daily cloud chart. We fell over up to the daily cloud chart, a little shooting star in there. I think it's not very clear, but it's there. And so yes, we looked back at the behavior of this over the course of this move and noted that the cloud chart did a good job. We did nudge into the cloud a few times, but as soon as we came back out again, that sort of signaled the next leg of the move lower, and a very neat interaction with the cloud right there at the end. So yes, the cloud charts can look rather messy, rather confusing, and in my experience, as I say, longer term time frames, they lend themselves to longer term time frames a lot better. I have found that using just the cloud and the lagging line can work extremely well. You should know that it is a trend following method, and it can get chopped about in sideways markets. I have always found that it's useful to use the cloud charts on 2 time frames, and they need to confirm each other, and then you're taking you're filtering out noise with that particular you know, by adding that caveat in there, if you like. I've seen an uptick in interest in this amongst professional investors. I know guys at funds who really love this method of charting, and you know, it's becoming increasingly popular. And I think that the popularity is that you know, if you just use the that, you know, if you're using it as a where are we with relation to the cloud type of thing, then it can really add some weight. The other thing I'd say that probably should be on, I think actually this is my last slide, so we've actually smashed through this rather quickly, is that I particularly find these useful, and I'm not quite sure, this worries me slightly in some respects, on Japanese markets. So it is maybe something that has maybe that's an element of self-fulfilling prophecy about it, because you know, they seem to work rather well on Japanese markets. And on that note of looking at Japanese markets, here is a daily chart, and let's just get rid of some of these things at the bottom for a minute so we can just look at our this is Euro Yen on a daily chart, and interestingly with Euro Yen, the last three, let's just go to now. Okay, that was Friday, that was Monday. No, sorry, that was Thursday, that was Friday, that was Monday, and this is today. Okay, that's quite interesting, isn't it? Today's range has almost been exactly defined by the two span lines. Okay, I've just spotted that myself. Right, what have we got here, people? If we think back to previous webinars, what are those three candles there? I can tell you right now, those three candles there form an evening star. Okay, and the middle one there, Friday, was a shooting star. Now, so in candlestick analysis, I was alert to this yesterday morning. I was thinking, okay, we've got you know, a new, and actually let's put this into some context. Okay, 130, and let's look, actually let's just put this into some context. Let's go to a weekly chart, and we'll lose the clouds for the minute. So now I'm trying to give you a bit of a run through my how I analyze the markets. Mr. Fibonacci, if we take it from the December 2014 high there at 150 down to the June 2016 low at 109.55, Mr. Fibonacci said that 134.40 was going to be a big level because that's the 61.8% retrace of that move. Okay, we got to the 38 here and fiddled around for a while, but then we got through the 38.2. Let's just get rid of that one just because that's confusing things. Okay, and then we got to the 61.8 last September, and we fell over. And then we got there in October and we fell over. And we got there again in November and we fell over. And whilst we were all away stuffing mince pies and all that kind of thing, well, I know that's what I was doing anyway. This one got above that 134.40 level. Now that should have signaled, should have heralded a move up to 141. But what actually happened, and so that's the weekly chart. If we go back down to the daily time frame, what's actually happened is we posted this shooting star on Friday. We confirmed it with weakness on Monday. On Monday, we broke through the Marubozu line of Thursday's big green candle at which was at 135.62, and actually as well I noted to my clients that this was a big intraday level as well was this high here from the 2nd of January. So there was a lot to say, there was a lot of reasons to say that 135.62 was a big level yesterday. And if we actually now go to an intraday time frame, what's this 30-minute chart, 135.62, you can see nice clean break of 135.62. That was really nice. Okay, so that was the that formed an evening star. And the next question on our lips now, right now, is: are we going to break back below 134.41? This was an old, you know, is the old resistance level and the Fibonacci level going to become a support level for us? We are testing that theory right now, today. Okay, and if that breaks, then we go a lot lower. Where could we go to if it breaks? we can look at we can stick our Ichimoku Cloud chart back on there, because that's what we're meant to be talking about, and we can see that the Ichimoku chart at present, right round here, has a very thin cloud and the cloud is right down at 132.80, around there. So that says to us that according to Ichimoku, a break below 134.40, which we're trying to do now, should take us down to 132.80. So I'm short with that, and that is something. And there's because this is a very powerful reversal pattern. We've given it some confirmation here, and we're now looking for this to come down to here to 132.80. And that is Euro Yen, and that's the daily chart. Right, is there anything on the weekly Ichimoku chart that agrees with this? We're bullish on the weekly, okay? Quite simply, the weekly Ichimoku chart is bullish, and very bullish really. And actually the cloud is right down here. The top of the cloud is right down here at 125. So a long way to go before the weekly chart hints at anything nasty. I have come across people in the past who use old cloud areas as resistance, but I've got to be honest, I haven't spent a lot of time on this, but there is an argument that that's what's happening here, that this cloud, the cloud was stuck here for a long time, and that's where we've now failed. But I wouldn't want to get you too excited about that, because it's that might just be coincidence. I haven't spent time analysing that particular form of that particular way of looking at things. What does the monthly say? Interesting. The monthly has us just flirting, if you like, or flirting is the wrong word, isn't it? Interacting with the top of the cloud, okay? Although the lagging line is above the cloud, so there's a few mixed messages in there, okay? But yes, interesting that we found these sellers at the top of the cloud on the monthly time frame chart, okay? So there is a sort of a potted analysis of 4 different time frames for Euro Yen, which has all come together to give us, as well as the fact that actually on the monthly we've got this massive, great big downtrend line that we've also just failed at, which is interesting. Right, so there was something I was going to show you. So if you're on the DF markets platform and you go to the advanced it's the advanced charts tab, then you can get onto the trading view charts, and a trading view chart it looks a little bit like this. So okay, everything's the same. The cloud's still very thin where we are currently. There's our nice evening star formation, and yeah, that's how it looks on the advanced charts on trading view, on the DF markets trading view platform. Okay, so that's Ichimoku. Let's have a look at, I'm going to go back to where am I going to go back to? While we're here, we might as well have a look at dollar yen on the Ichimoku charts and see what the current outlook for that is. On the daily chart, it's a mess. Quite simply. Okay, we've been in the cloud, around the cloud for a while. We're not getting any clean signals, and this kind of illustrates exactly what I was saying to you. In sideways markets, this can be problematical. Okay, if we were to look at the something like the S&P, I'm sure we'd have a different story. Okay, there's the daily cloud chart for the S&P, and yeah, okay, this is in a solid uptrend and has been, according to Ichimoku, since November 2016. And every time it dips into the cloud, it rallies. Okay. At the moment, we're a long way from the cloud, and the cloud is quite thick. The cloud is right down at 2,620. Long way off, okay? So a nice thick cloud going on there, and we're comfortably above it. The lagging line is comfortably above it as well, obviously. So I think actually it's turned out to be a lot shorter than they usually are, I'm afraid to say, but we've covered a fair bit, I think. I'm more than happy, I'm open to any questions or anyone that wants to look at any current markets, and we can look at them either using Ichimoku or any of the other methodologies that we've looked at over the weeks. So yeah, anybody got anything they want to look at? I know Chris will probably ask me about the DAX. It's one of his
No,
favourites.
I've fallen out of love with the DAX, mate.
Chris has fallen out of love with the DAX. That's not so good then. Well, the DAX, the Ichimoku chart is bullish. We did have an interaction with the bottom of the cloud there, but very quickly retook the top of the cloud and seems to be continuing higher at the moment. The lagging line never broke the top line of the cloud there on the DAX, so that's a bullish looking chart. Do you place any importance if the cloud is red or blue, i.e. if the cloud span A is above cloud span B? I think it's just a visual thing, really. It's a visual thing, and you know, if actually it's all blue on my charts, so I don't particularly. No, I don't. Is the swift answer to that one. You've got me a bit with that question, sir. I don't know actually whether there is whether in textbook terms there's any particular significance. I think it's all part of the visual, really. Does a thin cloud mean a weak trend and it can be broken easily? Yes, Nigel. Absolutely. The thinner, you know, and that's something to look out for is thin clouds, meaning that if and when we get to the cloud, it could easily drop through. Whereas the thicker the cloud, the stronger the trend, if you like, and the more chance there is that the cloud will do a job of holding for you. So yes, is the answer to that one. So have we got any more questions there?
Clive, while we give it a couple of minutes to see if we get any more questions come through,
Yeah.
are you still offering an extended free trial to DF Markets clients?
Yeah, I'm on. I think there's a few that are on that, and if anybody wants to, what I think I usually do a week, but if anybody wants to sign up for a free trial on my website, then yeah, why not? Shall we? We can. I'll let them. I'll let you have it till the end of the month. So what you would do is go to FuturesTechs.co.uk. There's my website there, and if you were to go to individual trader and ask for a trial. And then in the drop down there, where did you hear about us? There's DF Markets. If I see that, I'll get my people to keep an eye on that. And if they see that, then we'll extend it to the end of the month. How's that?
Fantastic. We've got a couple more questions, Clive, that have come through.
Okay, right, so let's have a look. The future cloud, what is the importance of that? I'm not completely sure. I haven't spent a huge amount of time on that. I think it gives you some indication of where the trend may change in the future, and where, you know, and so it just gives you that little bit of a look forward, if you like, which, as I say, you don't get from many or any other charting methodologies, to be honest. So you could say at the moment, in euro yen, looking at this chart, we have a very thin cloud down at 132.80, and that remains the case right up until the beginning of February, when things get thicker again. So it's almost a case of, right, if we are going to break this cloud, the best time to do it is before the end of the month, because if we are still above here when February kicks in, then the cloud gets thicker again, and that gives the bulls a little bit more encouragement that things may hold. So it's almost giving you a time frame to challenge the market to do something, if you like, to say, break, you know, if you're going to break the cloud, then, you know, do it by the end of January, because that's when it's at its thinnest. Hope that answers your question, Kim. And Nigel, what does the difference in size between the Tenkan and Kijun signify? That I'm not entirely sure, if I'm honest with you. I've not done any research on that myself and haven't seen too much about that in the books that I've read. I'm guessing it's there's some sort of trend. A little bit like the construction of the MACD that we looked at a few weeks back, where the wider the difference between the two averages, the stronger the trend. So there may be some significance in there, but if I'm completely honest with you, Nigel, I haven't spent time myself analysing that particular relationship.
Well, I think that's it for questions, Clive. Is there any markets in particular that you're looking at the moment that have caught your eye?
Well, I suppose everybody's always interested at this very moment in time in the old in the crypto world, aren't they?
Most definitely.
Now, how do I? Let's have a look then, shall we? I've got a little script. I've got my crypto charts on one page on TradingView at the moment. So let's have a little look. There's 4 markets on there. Let's go through them individually. Ethereum is leading the way, strong as an ox. Doesn't appear to, yesterday was a massive range day, okay, and yesterday was proof pudding, if you needed it, that these things really are very, very volatile indeed, and this is not for the faint-hearted, okay. Yesterday we saw gains to 12.21 and then a sell-off to 9.44. And then we got a lot of it back and actually closed higher on the day. We've made new highs today. It's trading 12.44. We've now posted 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 green candles in a row. That's not meant to happen. We've got a thing called the rule of 9, but if anything's going to break technical rules at the moment, it's going to be cryptocurrencies. So Ethereum is very much the flavor of the moment. Bitcoin is not. Bitcoin, look at this, okay? We failed this week, last week and this week at the 61.8% retrace, 17,000, and we've dropped back through 15,300 yesterday, and now we are testing. We've formed an uptrend line there. We're sitting right on it now at 14,500. If 14,500 breaks, we go back to here, which is 12,700. If that breaks, we go back to here and back to here. This could be back down at 8,000 by the time we next all come together in a webinar next week, if we break this level here. And so that's Bitcoin in a potted analysis, if you like. Litecoin is also looking similar to Bitcoin in that the euphoria phase was back in middle of December. We've seen a lot of volatility since. It's been all the way back down to what was the low there, 144, and then all the way back up to 321. This is Wild West, kids. This is crazy. These markets are really moving. I worry when I read stories about Dogecoin or something, a novelty coin with a dog face on it that actually, that actually doesn't mean, it isn't worth anything. Oh my goodness, what is all that about? Flavor of the month a little bit for a while, and as we at the end of last year and the beginning of this year was Ripple. And actually I wrote something about Ripple when it was on its way up, and I said that 338 was an interesting level, and it was a Fibonacci projection, okay, and we got to what did we get to? 331.70, posted this big doji candlestick, and we've been selling off ever since. We are now eyeing, and I think we will see this trend line here, which is at 175, somewhere around there, and I wouldn't be surprised if we see 175 very, very soon on that one, and then 138, and if we break 138, then we'll just go back to here again. So as I say, I think there should be massive wealth warnings attached to trading cryptocurrencies, and just be careful, people.
Fantastic, Clive. Thank you very much. I don't think we've got any other questions, so we will see you same time next week. And what was it next week? My memory's
We're going to look
terrible.
at market profile and volume and price analysis.
Excellent. And then in the meantime, guys, if anyone has got any questions or any sort of suggested topics or markets to look at for the 10th webinar in 2 weeks' time, please do email us
Yes, please.
on office@dfmarkets.co.uk or come contact us via the live chat function on the website. Clive, thank you very much.
Thank you, Chris.
Look forward to seeing you same time next week.
Cheers, guys.
Cheers. Bye-bye.
See you.